There are numerous ways to succeed as a trader. There are numerous ways and strategies that might support traders in achieving their objectives, rather than being based on hunches. Whatever is going to work for that person is frequently going to be a defined and systematic strategy. The ability to manage one's emotions when trading could mean the difference between success and failure. Keeping a level head is crucial for continuous trading because your mental state has a big impact on your decisions, especially if you're new to trading. Before continuing, if you are new to the channel, don't forget to hit the bell button and subscribe so you won't miss any of the next videos we release. Professional traders aim to avoid having a single impulsive choice wreck their entire career, rather than taking the possibility that it would hurt their account. Learning how to reduce your trading emotions can take a lot of work in many trades. 1. Don't act on anger. We all experience moments of rage trading. Maybe the unexpected market movement caused you to lose your cool. Maybe the market changed in your way after your stop was made, but you're not on board anymore. Perhaps you were preoccupied and missed a fantastic trade. You might become irate over a lot of things in trading. It's impossible to constantly avoid. Humans naturally experience anger. It is not anger itself, but what you do with anger that's significant. As soon as traders experience rage, they could act out in an inappropriate manner. The trader may place a revenge transaction, thinking, "I'll prove to the market who's in charge," in order to express your anger at what you are going through. You could exaggerate a position or act out in other ways, like take a break, map your rage, label your emotions, become friendly with the feeling. Recognize that you are a human being with feelings like anger. 2. Don't marry your positions. The trader may become obstinate and stick onto a position in the vain belief that it will turn around. Close out a losing deal as quickly as you can. Accept your loss, and carry on. Analyzing your potential errors all the time will benefit your trade greatly. It helps you clarify your thesis by making you rethink your positions. More importantly, it can assist you in becoming less dependent on your possessions. Additionally, you exit when specific events occur. You sell an option position if it is reduced in value by half. Get out if it doubles and then pulls back to even. These guidelines ought to be strict so that we can avoid being duped by our minds and emotions. 3. Follow each trade with a break. Majority of traders typically feel stressed out by all the events they have missed. They frequently end up losing money in trading because they lack confidence and preparation. Never assume that the currency pairs you are trading will stay within their typical trading ranges and will respond to the same market trends. So, take time to catch up. Prepare for the trading week ahead and transition your trading. Another good idea is to reduce your trading hours. You must consider how exhausting trading for extended periods of time can be in addition to getting adjusted to the stress of trading again. 4. Set a fixed point at which you stop. Stop and take a good long break after 3, 4, 5, or whatever number you decide. The majority of blunders occur when one trade is followed by another. Review your trading plan and consult your trading journal. Some traders prefer to trade the 1-hour charts because they feel most at ease doing so. The number of trade signals is lower, but not too low. And the time frame is longer, but not too lengthy. Trading in this time frame allows you more market analysis time and less frantic feeling. 5. Don't keep track of profit and loss. Calculating your earnings will merely stir up your emotions. Focus on developing your trading approach by going over your trading log. You can then evaluate your performance at the conclusion of the trading day. Some traders design a form and duplicate it so they can quickly fill it out throughout the day. They even design predetermined indications that they can check off or circle, and that correspond to their strategy. When it's time to assess their trading strategy and success, they compile their diary sheets at the end of the day into a 3-ring binder. 6. Keep your mind on the plan. A trading strategy only works if it is adhered to. To trade according to a plan, you must follow it no matter what. That requires self-control. Absolute discipline. Discipline lacking traders do not follow their trading plans. You must exercise discipline. When you make a very specific trading plan and comply with it, you can win with justification. A successful trade is justifiable and strengthens discipline when it is executed according to a trading plan. When you stray from or entirely abandon the plan, you win unfairly. You might receive a reward, but the result was random. 7. Don't confuse prudence with fear. You want to trade sensibly, making use of reason and logic. This can cause you to delay making a trade. However, make sure that caution, not fear, is what led to your choice. By preventing you from making a trade, fear might ruin your trading. In essence, this is the approach that traders employ when selecting a trading strategy. They look at what has already occurred and use that as a foundation to forecast where future market prices are likely to go. Always understand the operating principles behind the trading methods you use. 8. Watch out for greed. Greed causes you to make illogical decisions. For traders, this typically manifests as over-leveraging, excessive trading, or holding on to foreign exchange trades that you know you should have closed off long ago. You'll have to acknowledge and accept that you won't always make the best decision. There can be occasions when you don't see the entire market move or when you completely miss a good setup. But that is simply the way trade operates. You'll be more focused on adhering to your trading objectives and less likely to give in to greed once you realize that the market is bigger than you and that mistakes are inevitable. 9. Manage your stops carefully. Set stops in accordance with the framework, trading strategy, or current market conditions. Do not base your exit levels on your loss tolerance. The market is unaware of your financial situation or your risk tolerance. It really doesn't give a damn. Prior to managing your position size, identify the stop levels that will show that your trade was incorrect. To end your trade, use limit orders. Your stops should only be moved in the direction of your profit aim. Widening stops are awful. Trailing stops are excellent. 10. Don't give up. Just keep in mind that it's not the end of the world when you're ready to give up on trading because you're feeling frustrated. To get back on track, take a step back and step away from live trading for a bit. Reevaluate your trading strategy to ensure that you are comfortable with it, that it is not overly complex, and that it makes sense to you. You don't need to find the holy grail of indicator-infused perfection. All you need is a strategy that offers you an advantage across a series of trades that gives you slightly more than a 50/50 probability. That's all for today's video. Guys, tell us your views in the comments section. And if you're new to the channel, don't forget to subscribe. Thank you very much for taking the time to watch this video. See you in the next video. Cheers.